There's a couple things going on in the stock market this year that's really increasing the risk for all investors. And if we do have some volatility going forward or a weak market, there's a lot of investors that's going to feel a great deal of pain and take some major losses. So let me get into what's going on. First of all, there's a borrowing binge going on, borrowing money to buy stocks. It's lifting the stock market and investor risk to new heights. And leveraged funds and margin debt have grown to unprecedented levels this year. Let me get into the facts. Okay, first of all, U.S. margin debt. Okay, what investors borrow from their brokerages to buy securities rose 54% to a record $1.4 trillion in May from a year earlier, and that's according to FINRA. Okay, meanwhile, high-risk leveraged exchange-traded funds that produce double or triple the daily move of an ETF or the underlying stocks are growing rapidly, and so is trading options tied to them. The risk of buying leveraged funds are well advertised. A 30% drawdown, for example, could result in the underlying ETF to drop 90%, okay, wiping out the fund. Okay, so let's get into some more of this. The leveraged ETF boom, okay? ETFs that move double or triple, let's say if one is tied to the SP 500. If it's a 2-time leveraged ETF tied to that, if the SP 500 goes up 5%, it would be projected to go up 10%, okay? What most people don't understand is that is not a long-term projection though. So let's just look at the amount of money going into these leverage type ETFs. Back in, shortly after 2020, there was only about $47 billion invested in those types of funds. Now we're well over $200 billion. In fact, we have $66 billion in leveraged ETFs just tied to semiconductors. Another $81 billion in tech-related leveraged ETFs that don't hold semiconductors, and then another $71 billion. Okay, so a total of $218 billion in June of 2026. A rapid increase in the amount of risk investors are taking. Now, let's look at how these work and why they could be a trap. Okay, take a hypothetical stock with a twice daily ETF that tracks it. Okay, so a double leveraged ETF. Imagine both start at $10 a share. If the shares fall 30% on Monday, the double ETF tracking them will fall 60%. Okay, so if the normal ETF or stock falls 30%, it would be at $7. The double leveraged ETF would drop 60%, it would be at $4. Okay, now let's say the stock roars back 50% gain on Tuesday and is now up on the week. Okay, so the stock at 7, if it has a 50% gain, it would be at 10.50. You would actually have a gain after those 2 days. But look what happens to the double leveraged ETF. Okay, it would, let's say, rise 100%. But it was at $4, so it would only get back to $8. It would still be showing a 20% loss on the week so far, where the underlying stock actually had a gain. And this is what happens with these leverage, or can happen. Now, of course, these are dramatic drops and gains in 1 and 2 days. However, it shows the dramatic compounding effect. Because what happens is, let's say if something goes down 50%, it's got to go up 100% to get back to even. If something drops 70%, it's got to go up 233% to get back to even. An 80% drop would require a 400% gain just to get back to even. Losses, okay, hurt much more than gains can make up for, equal gains. Okay, so this is why cutting losses is so key, and protecting yourself a little bit, not becoming too aggressive. Now, what people don't realize about these leveraged ETFs, they're designed to deliver 2 or 3 times the daily return of an index. Okay. Leverage resets every trading day. The fund rebalances daily to maintain its target leverage. Long-term returns are not meant to be twice or three times the index. Daily returns compound, causes the returns to diverge over time. Performance depends on the path the market takes. Steady trends can help, okay? If we're just going up all the time, okay, those leverage returns can compound, and that would be great. But volatility or declining markets often produce far worse returns than investors expect because those losses also compound. Okay, so if you buy a 3 times leverage ETF, long term, don't expect 3 times more gain or 3 times more losses. That is only their target for a specific day. These are not meant for any type of long-term investments. They're designed for daily performance, daily trading, daily hedging, and things like that, not for long-term investing. If you're using them that way, okay, you're taking on a great deal of risk. And lately, it's been working great. But at some point, we will have a weak market. And there's a lot of people out there, whether they're borrowing money or using these, that are going to get hurt badly. Okay, so why most investors should also avoid borrowing money. First of all, gains are amplified, but so are losses. Interest expenses lower your net return. Margin calls can force you to sell when you really don't want to, when prices are down. And successful investing is about patience, not leverage. Okay, borrowing doesn't make investing smarter, it makes investing more risky. Okay, so the important thing is to have a game plan, stick to it, stay diversified, and don't start borrowing money. It's not a good idea to borrow money to invest in the stock market. And if you're buying these 2 and 3 times leverage ETFs, you're taking on a great deal of risk, and you may be very happy these last 2 or 3 years. But if we have another year like we did in 2022, okay, when the S&P 500 was down 18%, there's a lot of people out there that is really going to get hurt badly. So I hope this has been helpful. A few things to keep in mind. Thank you for watching, and I'll see you next time.